morning, all. First of all, thanks for attending this session and take this session as an opportunity to take it on the current market outlook. So, what's the overall overview in the considering the current market volatility and what we should do it? Because one thing what we have seen in recent past, if you look at markets have started having volatile. So you have seen that one day markets are up by 2%, another it's down 1.5%. So it creates some sort of a jittery in investor mind that what we should do it. So for that, we thought of to have a one session to explain what are the things which we should look at before taking any call in terms of overall allocation perspective and how we can create a long-term wealth. Yeah, so first thing I would like to convey to all the investors that markets are supreme and markets always factor in things before actually their negative impact started coming up. So to give an example, like earlier when we have seen in 1973-74, when inflation have picked up and how markets have reacted. So one thing which we have to understand that the moment we start seeing that things are going worse, actually those are the times where you will see that markets are bottoming out. So one most important lesson from market what we can learn is that don't wait for things to improve, because till the time things improve markets already would have moved up very significantly. So you can see it here from a chart perspective that the moment interest rates started picking up in 72 73, market started correcting, but the moment it made a peak out, and from there if you look at before it went to a larger correction of inflation, markets already reached on their highs. So the most important part is that don't go just by the headlines, look at what is future. And the best example we can see it from COVID also. So when COVID peak out in March 20, we have seen that markets have corrected across the world almost 30% plus. But before case started coming down, markets have bottom out. So somebody who wait that okay, when things will improve, I'll start buying. So that is not a case. So for that, what we should look at the market valuations, because if market correct and we get the things at a good price, that's where we should add. And one of the famous quote I want to give it here: in markets, either you'll get a good price or good news. You will not get the both the things. So sometimes we should not look at that. We will have all the good news also in the market. And if you look at from an India perspective, because that's where we are investing majorly. So India is the fastest growing economy across. If you look at and the recession perspective, if you look at they are the lowest probability of recession. So one thing what we have seen from asset allocation perspective also that India will do very well compared to emerging markets and other economies. And you can look at from the past data also that how India has delivered returns even in the USD forms, because as an investor, especially for NRI, we have to take into the consideration the currency risk also, because as you have seen that major part of the world currencies are depreciating against USD. So if you look at even in the USD terms, India did well on the overall total return perspective. Yes, it may not did well compared to US if I look at from the USD terms perspective, but compared to emerging market, we did well. And one other thing, what we can see that if dollar era started going out, you will see that countries like India will do very well. And last week we have seen like McKinsey have come up with a report that this decade, not just decade, this century is going to be for the India. So there are a lot of positive reports which are coming up for India. And one of the interesting thing, if you look at from a market perspective, that the dependency on the FIs have reduced very significantly. So you can look at that in the recent fall when FIs have taken out almost 2.5 lakh crore, and mutual funds and DIs have added the major part of this. And in that, if you look at, the major contributor was the SIPs, because as now Indian investors started realizing that you cannot time the market. The best way of investing is you do a regular investment allocation and focus on your goals, so that over a period of time you build good long term wealth. So that's a trending change what we can see from market perspective, that now Indian markets have become much more resilient and much more internal dependent than the external dependency. And this is the one of the most important thing, which I think as an investor we have to understand, that the whole market growth, if you look at over a longer period of time, it's only the earnings. So all those noise what we heard, that recession is coming, things are going bad, all those things, but if you look at and focus on the companies which are doing good and which are not dependent on a large extent on the external factors which is going to drive, then those companies will continue to do good. So you can look at how Indian markets market cap and the long term profits both are combinedly coming at to equivalent level. So one thing which you have to look at, that if we have seen 15% type of market growth in a long term, this is because our earnings have grown in the same way. The only difference is that sometimes your earnings may not grow and market move up, and sometimes earnings grow and market doesn't move up, because markets always take things at a front level. The another positive factor, if you look at from an Indian market perspective, or corporate profit to GDP has picked up compared to where it was, and we are going above average. So that also shows that now corporates have started putting their funds towards new capacity creation and new allocation perspective, as over credit growth also picking up. Secondly, we look at from a valuation perspective. I think today we are at a comfortable zone from a valuation perspective. So before taking any call during market volatility, first thing we should look at from a valuation perspective. So today we are not very expensive. So this point of time we should not look at to go and sell. We should target that whenever any larger correction happen, to buy. So that's one of the basic thing which we have to understand, that don't just look at the frontline index, look at the valuations, because as your earnings grow, as companies earnings grow, automatically valuations also correct very significantly. So currently overall our outlook on the thing, we are largely overweight on the large cap side, because that's where we seen that if you look at last 1 year, they have not moved up very significantly compared to what we have seen in mid and small cap, and mostly large caps are will be more resilient in terms of any sort of a major market volatility. So currently the strategy should be more focused, that keep higher allocation on large caps, do profits booking if it's on a larger extent with the valuation high on a mid and small cap, and any correction should be opportunity to invest. So we should not be looking at these headlines saying that recession is coming and trying to take out from equity, because valuations have come down very significantly and Indian markets are but better placed. But there are certain pockets where we can look at to do a profit booking, especially on a mid and small cap side. And what we have seen earlier also, that whenever we have seen the larger correction, if you look at markets did very well post correction. So even in the recent correction also, if you look at pullback has been very strong, and what we are expecting that market continue to do well, considering now the festival season are coming and we have a strong monsoon. So that also should add on the overall level. And plus, if you look at the way GST collection is picking up. Currently, we have almost like 1.5 lakh crore GST collection with very good income tax. If you look at the tax collection on the direct tax side, also has been a very strong side. And the way governments are doing a spending, especially towards railways and road. So those infra spending also adding a lot of value in terms of overall economic growth, apart from the corporate side, whatever we are doing. So overall, if you look at fundamentally, things are good from an India perspective. And the indicator which shows, like for example, manufacturing PMI index, or we look at overall consumer confidence index, these are positive on India side. Yes, we have a bit of negative outlook on the global market. That's one of the very interesting thing to showcase that how the valuations play a major role. I think that should be the thumb rule for any investor to take a call on the market. So if you look at current valuations, we are around the long term averages between 20 around. So there was a time, if you look at in 21, where we have on a very high market valuation. Those are the points where we should look at to do a profit booking. So the most important part, which I think we have to understand, that have understanding of the market valuation. The moment, if I look at the moment it's going on the higher band of valuation, these are the time we should book a profit. But currently we are not in that zone. So 21, and if you look at, we had higher valuation. Now we are much more comfortable situation compared to where we were earlier. So the next part from a technical side, so we are trying to have market outlook from both the perspective, from a fundamental perspective and from a technical perspective. So if you look at from a long term perspective on a technical side also, on a worst case scenario, if global market correction continue, we can see it on a Nifty level around 14,000 around. So that would be the level where we can see a good level of allocation which can go on the investment side. So if you look at from an investor perspective, where they should do the larger allocation, it would be when index reaching around 16,000 and 14,000. So these are the, if you ask me, two levels where we should look at to do larger allocation on the equity. And you can see from past also that how when markets are coming towards their long-term averages, how they have done it. So the base rule for investing also is similar to what we do it in a day-to-day life, is buy at low and sell at high. So, but what is low, that we have to understand. So for that we have to use both fundamental and technical. So currently, based on the combination, what we can suggest, 16,000 and 14,000 around would be the level on the index perspective, where we can do a large chunk of adding on the equity side. From a short term perspective, we are a bit negative on the market because markets are not able to make a new high. So you can see it here. We are continuously in a lower trend, so which suggests that we may see some sort of a profit booking, but the fall will not be very significant if we look at on an overall market perspective. So we may see some 5 to 10% correction, but those corrections will be a good opportunity for us to do allocation on the equity side. So how to handle this market volatility? For that, we have to understand how the sector rotation and the asset allocation play, because that is the most important part as an investor we have to look at. So to give an example, if you look at 2021, if you look at the index return of technology, that was on the highest side. But if I look at for this year, technology is the one which is underperforming very significantly. So these are the things which normally as an investor do a mistakes, that they try to invest into the sectors which are doing phenomenally well at this point of time, because sometimes that's something where we have to do profit booking, and we have to look at that there could be a certain headwinds which will impact the overall portfolio returns. So I think looking at the valuations and the sector rotation will help us to do the allocations on a right way. The second most important, what we have to look at from an investing perspective, have understanding of the market volatility, because the moment volatility increase, these are the sign that markets maybe have a larger move. So we have seen that in 2020, suddenly volatility have jumped up very significantly during COVID time, and we have seen how markets have corrected. So this is one of the indicator which can be used as early signal that market may see a larger correction, or it may be a larger volatility, which means our strategy should be changed to invest more on a systematic manner when volatility is higher. So the another way of investing is that not do a lump sum allocation when your market volatility is higher, because we may get a good opportunity on the lower side also. So next we'll take a poll. I think Sanjay, we can. Yeah. So what do you think will be Sensex 3 years from now? Yeah, good to see 80% of overall poll has been on positive side. I think we are also expecting that India should do very well in next year perspective, and we should see making new highs, because the way India economy is growing, I think it should do well. Yeah, so now the major point, what are the short-term concerns we have? See, the major part of concern, if you look at today, we have from a global market perspective, especially on the technology side. So if you look at the way technology stocks have moved up, and post that the way correction has started coming, which is showing a early sign of major breakdown. So we are a bit negative on global market perspective, and overview is that that could be the leading way for a bigger market correction. So overall overview is that on a global markets, we have to look at to book profits on the larger up move than increasing the allocation, because they are currently have a higher issue in terms of any sort of a bigger correction. And we can see that in past how things have been. So earlier also in 2000 we had a crisis. That point of time, how markets have corrected, and it went down very significantly. So if you look at even Nasdaq had a pullback last month, but that pullback was not sustainable, and again market started correcting. So this is something which is showing that markets are already in a mode of profit booking on the technology side. And what we can see and learn from the past Fed hike. So if you look at typically at the early stage of rate hike, we will see a correction, and after that, if you look at markets have started going parallelly with the earnings growth on a positive side. So that's also is another concern what people are having it, that as US Fed has started increasing interest rate, will it going to have a major impact from a market perspective? So you can see that in the earlier hikes also, Indian market did very well because the external dependency also have come down now, and it will be more dependent on how the earnings will grow. And what we have seen, if you look at this is the last 30 years of a chart, that equity has beaten all asset class, and these type of falls will be just a blip. So if we look at on a long term perspective, market will continue to do well, and that's a one thing which we have to understand, that it work in a cycle. So we had last 2 years as a good run. So this year is a more of a profit booking and consolidation year, and again we'll take a move. So whenever we look at equity market returns, we have to look at from a 5 year of a cycle. So in a 5 years, we will have a one or two good year, which will cover up the earlier years. So we cannot look at in isolation that how every year markets are giving the returns. And what is the overall long-term view? I think we are very positive. So $5 trillion dollar economy, that's the dream. What we have is going to become as a reality. What is going to lead it for the same? If you look at the way infrastructure level investments are happening, and secondly, if you look at the recently government has come up with the policy of where they are promoting all sort of a manufacturing activity. So which is going to help. India to become as a manufacturing hub. So already we are very strong on the services side. Now on the manufacturing side also, with the government incentive, we are going to see a good growth. And already if you look at, there are two, three sectors which are emerged very well. Auto has come out very well on the export side. Then if you look at chemical is another sectors which is picking up. And third is the contract manufacturing. So if you look at, these are the three larger sectors which have come up very well. Textile, yes, it has been not a great move compared to what it is expected, but still we have a hope that we can revive even the textile sector also from a growth perspective. The most important part, I think, the demographic dividend, because we have a working population, and now with the way digital I think wave which has helped India demographic dividend to take to the next level, because this is helping to make unskilled also to have similar type of capability what as a skilled worker will have. And the fourth most part is, I think, the way startup culture is getting built up. The entrepreneurs are coming up and adding the overall growth. And the biggest driver which will come up in future is the lower interest rate. So today, yes, we are in a higher interest rate scenario, but over a period of time, India is going to be in a lower interest rates, because that is something which is going to drive the overall economic growth, and that's something which is possible the way we have a very strong savings. And you can look at the way corporate profitability is picking up. Along with that, what is the overall GDP level or contribution? So this is something which is going to drive the market. So I think our corporates are will be the driving factors, with government creating a whole ecosystem which is going to help the markets. And if you look at the 5 year perspective on Nifty growth with the EPS growth, so typically, if you look at, it goes in a similar phase where we have a 15 to 20% type of EPS growth, and similarly move we have seen on the index level. So I think that's the one thing which we have to understand, that we have to look at in a cycle or 5 year cycle perspective, not on a linear 1 year basis how markets are going to do. How do we handle the market volatility? Because that is the most important part, I think, which people are trying to look at, how we handle this type of volatility. I think the first foremost thing is that don't look at your portfolios on a day-to-day basis, because that will create more jittery. I think investing more than about having a financial acumen, it's more about how we react or how we handle our investment. So the first thing is that it's a long term thing. So we also have to build a habits of looking at things from a long term perspective, to do it more like a monthly and a quarterly level portfolio view, not on a daily basis, because that will make you to do a wrong decision. So that's a one thing which we have to look at. Second thing, things where we have a strong conviction, we have to do a averaging and make it as long as overall perspective, cost reduce. So to give an example, for example, you have invested on the technology sector, especially, and where we've seen that okay, technology is going to bottom out and it has corrected 20%. If you have invested, for example, 2 lakh in the same, so if you do an additional investment, and so that makes your average cost also come down. And secondly, when markets started picking up, you will have a good benefit. So typically what we suggest that for any sort of portfolio averaging, we should have at least 20% as base correction from where you have added earlier. I think we have to create some thumb rules of investing, so which helps that where we should do it. Yeah, so I think the next most important part, dynamic nature of market and how we should look at to do or asset allocation, because I think that's the most important thing which we have to consider at this point of time. So you have seen that in a different time frame, how different index. So always people have this question that everybody talks about when to buy, but nobody talk about when to sell. So I think your asset allocation will help you when to sell. So if you look at today, mid and small cap have done extremely good, and that's a time where we should look at to sell, because on a risk reward perspective, they are not at better place. So the answer of when to sell always come based on market valuation and your asset allocation. So today, overall, our view is that sectors which have done extremely good and they are at a very high of valuation, we should do a profit booking. And we have seen earlier also, like in calendar year 17, if you look at mid and small cap did very well, and you can see after that next 2 years how they have been. So that's a rotation which have been across. So if there are time when large caps do well, there will be time when mid and small cap do well. Same way it goes on a gold also or on a bond also. So each asset class go through a cycle. So we should try to book up profits when they are doing extremely good and add more when they are in their correction mode. So if you look at like 1920 was a good year for the gold, and 21 has been a consolidation of profit booking year, and 22 also looks like going to be remain in a similar way. So two good year, and after that gold had a good round of a profit booking. Large caps, if you look at predominantly, they have been very consistent in terms of performance, but there are times when they have not done great. So that's where they have made. So in 17, calendar year 17, you can see they have made 28% return. Next year, given 6% positive, where mid and small cap have given a negative returns. I think the most important part on the behavioral side, how we overcome fear and greed. So I think we have to have a basic thumb rule of investing, that buy at low, sell at high, and what Warren Buffett say that never sell at a loss if you have done the right decision. So for that, I think the most important part is that do a systematic investment and do a profit booking also. So both the things are essential. So entry and exit both are the part of the investing rule, but for that we have to have a regular review of our whole investments and take a call accordingly. How the overall equity allocation model works, and this is the one thing which we are trying to work out, that how our allocation should be decided and what are the factor which is going to lead in terms of the equity allocation. So currently at this point of time, we are almost like a balanced approach where we are suggesting like a 50% around equity, 50 to 60% equity, and 30 to 40% debt allocation, which is based on the earnings and the GSEC yield basis. So, but there was a time where markets have picked up when we have reduced the equity allocation very drastically. So, I think that's the most important part to understand, that when valuations become very expensive, we have to take a call and do a profit booking at a portfolio level. And secondly, on based on the sector sub asset allocation, mid caps to large cap and small cap to large cap. So whenever their valuations go on extreme, those are the times where we have to look at to do a profit booking on a respective segments, because mid and small caps typically do well, but over a longer term they have a higher market volatility also. So when market corrects, mid and small cap are the one who will be have highest correction compared to the large cap. So we have to be very careful in terms of investing in a mid and small cap. We have to do a regular profit booking, which may not require very significantly for large caps. So currently, if you look at what is uncertain, how much central bank will increase market for further global economy into recession. Yes, people are already talking that US is already in a recession, but one thing which we try to convey that recession is not going to be remain for a longer period of time. So typically, if you look at on an average, recession is being max to max between 1 to 2 years. So that's another thing. When will inflation will peak out? I think there are certain other external factors, and especially the way Russia Ukraine war things are going on, and the other factors. So but I think the moment we see inflation is peaking, I think that would be the best time for market for getting a turn. I think what is certain in terms of overall perspective is that investing in a right way. I think the right way of investing is that have a overall understanding of market valuations, and we have seen that whenever markets are available in a lower valuation side, so we have seen a portfolio did well. So when P is below 22, that's where if you look at 3 years performance 62%, and when P is on the higher side, we have seen that what type of maximum drawdowns we have seen. So I think that's one of the base thing which will help us to do a proper asset allocation instead of going through all these headlines numbers. So in a summary, I think while in short term there could be a volatility, but I think in long term we will see that it goes like a blip where we have seen it will pick up. I think current market valuations are in a comfortable zone, and we see that if we see another 10 to 15% correction, it will be a good opportunity to add further. And as we have suggested in a mid and small cap, selectively we can look at to do a profit booking. And how we manage our market volatility, I think the most important part go as per your goals. So if goals are nearby, then it makes sense to do some sort of a profit booking on the equity side. And secondly, how we are doing our investment, not do a lump sum allocation at this point of time, phase it out, and do allocations more in dynamic funds or funds which they do hedging and follow the asset allocation. And I think overall outlook, as already suggested, I think we are neutral at this point of time on the overall equity perspective. I think that's all from my side. Thank you. I think, and now we can have a Q&A. I think, so I think the first question which came from Neeraj, so uh, when to sell or withdraw, I think as we have told, two things which we have to look at when to sell or do a profit booking. One is looking at valuations when it is on extreme side, which we show that how it works. And secondly, sectors or which have done extremely well. So those are the times where, based on valuation, we should do a profit booking. So currently, mid and small cap is the area where we have seen that it did extremely well, and that's where we can look at to do a profit booking. Okay, which all sectors are going to do well to achieve this? So I think first sectors where we have seen which will do very well on the banking, because in the higher interest rate scenario, corporate banks do well because they have a very good AUM which have taken at a lower interest perspective. So banking should do very well, and auto is doing well because if you look at from a very long consolidation now, it started picking up. And the way in IT we have seen the correction, now it has come to a good comfortable zone. So I think IT also should add value on the overall level. And as the overall theme perspective, I think sectors which are more India dependent will do well, because global market will have a more uncertainty compared to India market. So I think as a whole, India will do well compared to the global side. And best way of investing is that focus more on the multi-cap side at this point of time than going aggressively on a large and mid and small cap, and do it more systematic allocation or dynamic fund allocation, or whenever we see a larger correction, that time do a lump sum allocation. Yeah. So the next question came that in terms of market cap to GDP, where we are. So currently, if you look at it on a market cap to GDP, we are around to their long-term averages around. So we are not very expensive or cheap at this point of time. So that is the reason we are neutral at this point of time on the market perspective, and we see that there could be a correction to add more.
Sir, we have one or two questions in chat box also, so we will take it. One question is, will IT sector recover the losses? Should we buy more IT shares to average cost?
Yeah, I think overall IT at this point of time, from a valuation perspective, I think it has come down to a good level, and we can do averaging in the IT sector, because I think it should pick up well, because the concerns what is there on the IT sector, they are more related to cost side, which I think should be able to handle. So I think IT can be done at averaging at this point of time. And there could be a two level of averaging. One, it can be done now, and one, it can be further 10% correction. We are not expecting beyond 10% correction in IT at this point of time.
Thank you, sir. The next question is like, is 2008 like global recession is coming? So we have a theory like, is global recession is coming.
Yeah. So, the most important part which we have to look at in 2008, what type of valuation we were trading and where we are today. So that is the one most important thing which you have to look at. So today we are not so expensive the way we were in 2008. And the way, if you look at the corporate profitability, all other things were at a peak. So if you look at most of the fundamentals factors perspective, we are not at a peak. So still the capacity utilization, credit growth, or corporate profit to GDP ratio, all still are towards the long-term averages only. It's not at a peak. So we don't expect that we will have such a significant correction. And secondly, I think what are the factors which drive a market? One is your liquidity, and another is your market valuation, and third is the earnings. So I think from that perspective, if I look at liquidity perspective, I think FIs, after 7 to 8 months of continuously selling, now they are started buying, and we have very strong local DI purchase. So I think liquidity side, I think we have a strong on the upside perspective. Secondly, from a valuation perspective, we are in a comfortable zone except in a mid and small cap. So I think that also is something which shows that the correction should not be beyond 10 to 20%. I think 10 to 20% correction we have to live it, because I think that's the nature of market. So any point of time, if you see 10 to 20% type of correction, do more allocations where things are at a comfortable zone. And third is, I think the earnings growth. So earnings are picking up very well. So especially cyclical sectors or sectors which are beaten down have started doing well. So that way also we don't see any concern in terms of earnings perspective. So I think from India perspective, all the factors which lead for a overall market growth are on a positive side. So we should, any correction which is coming because of the global market correction, that should add more value to add than to sell.
Thank you, sir. The next question is that can you please enlighten on taxation on redemption units of debt fund for NRIs?
Yeah, so I think a taxation perspective, there is no difference. Come be it a resident Indian or NRI, the only difference from tax deduct at a source. So for NRI also, up to 3 years, if they are taking out for debt, it will be added to income, and after 3 years, 20% with the indexation will be the taxation. So the taxation will remain same for resident or NRI. Only thing, tax get deducted at the source for the NRI. And which, in case if they don't have any other income in India, they can file their return and get the refund back.
Thank you, sir. The next question is what about the TCS stock future? Any idea?
I think overall we are positive on the large cap IT side, because currently the major reason of corrections, which is more on the wage hike and the attrition. So I think larger companies will be able to handle it much more effectively than the smaller IT companies. So I think it should do well. And plus, you have seen in past also that whenever there is a larger correction on the IT stock, they start giving the higher dividends and buyback. So those things also will help to re-rate these companies.
Thank you, sir. The next question is, can you please give view on infrastructure sector going forward for 3 years? I agree with your view on IT and banking.
Yeah, so I think infrastructure sector, one thing which you have to understand that as the infrastructure as a theme will do good, but the issue is that most of the companies which are dependent on the government in terms of the order flow or in terms of income, they are going to have always what I can say, a time where will their profitability is not consistent. So as a sector, we are bullish, but on the individual companies, we are not have a very positive view, because there are a lot of external factors which are impacted. So instead of that, what we suggest that look at the sectors which are indirectly beneficiary of the infrastructure, like for example, pipes companies, or you look at companies which are helping indirectly to the infra development, so tiles, pipes, adhesive, all those things. So because they are not getting directly involvement with the government, so what we have seen that any sectors where government involvement or government level things come up, the chances of consistency of the performance will not be there. And PSU banks is the best example. You have seen that how wealth has been destroyed in PSUs.
Thank you, sir. I think we have one or two more questions. So the question is, bank FD rates are gone up recently. In the long run, will the bank FD rates to go down or to go up?
I think long term we should see it going down. This year maybe we will be on a higher interest rate scenario, but I think next year onwards we will start seeing it. It's going down, because India as a developing economy, we cannot be on a higher interest rate scenario for a very long period of time, because it's going to impact our overall growth. So I think in maybe next financial year onwards, we will start seeing it going downward slope on the interest rate.
Thank you, sir. The next question is what at the Tata still should buy at this level?
I think maybe individual companies question, you can send a mail, we can reply, because I think we will look at the multiple factors before giving a call on the individual stock level perspective.
Okay, sir. I think the next question is also on Ultratech Cement, so we can
We can write and we can reply, because I think individual stocks, there are multiple factors matter. So levels we can give it only looking at all those things.
Okay, thank you, sir. And Mr. Jagannath also, asked for some best companies for investment. So, Mr. Jagannath, we will contact you and we'll send you the details. Thank you, sir.
Thank you all for attending. Have a nice day.